My name is Samuel Blocker, and this is my investment strategy for Finance 452. The name of my strategy is CAN-SLIM. CAN-SLIM is actually an acronym. CAN-SLIM is an investment strategy that looks at multiple criteria when picking a stock to invest in. The criteria both is tangible and intangible, and it was developed by William O'Neill. So what CAN-SLIM stands for is current earnings, annual earnings, new, supply and demand, leader or laggard, institutional sponsors, and market direction. So current earnings is simply you look at the EPS per quarter, and you want to see if it's grown over the course of a year. So the first quarter, you want to match it up with the last year's first quarter and see if it has grown since then. The other tangible part of CAN-SLIM it looks at is annual earnings. Overall, you want to see an increase in earnings consistently for the most recent 5 years. The next thing is new. You want to know if any positive change has occurred. This strategy believes in adaptation, and for a successful company, you have to constantly be making adjustments. So they want to know if you had any new CFOs, CEOs, any new markets you've entered, any new products you developed, such as that. Supply and demand, I guess that's always important to look at, just simply how much demand is there for your product or service, as well as how much supply do you have of it, can you meet the demand. And then also wants to know if you're in the leader or laggard position. Simply put, does your company innovate or does it imitate? And institutional sponsor, that's a big one. Worthy stock has institutional investors. What William O'Neill explained is that you want to look between 3 and 10 institutional sponsors, 3 being the minimal number, 10 probably being the maximum, because more than that it might be overvalued. But if it has no institutional sponsors, that means they've already looked at it, they're not interested in it, and neither should you be. And then last thing is market direction. Are you in a bear or bull market? Is your product in high demand? That kind of goes hand in hand with the supply and demand. So getting into it, the way I decided to test to see if this was a very feasible strategy or not, I picked the top 10 stocks, or the top 10 projected stocks following the CAN-SLIM model for 2015, as well as the top 10 projected stocks following a growth model for 2015, and lastly, the top 10 high dividend stocks. And so what I did is got an average of all of these for the past 3 years, not a weighted average, just a normal average, and did the standard deviation of the return, and I also kind of found their average beta to see just how much risk was involved. So this is a little chart I set up, just super simplifying it. The first thing is CAN-SLIM. As you can see, the average beta was a 0.59, which was significantly less than the growth. The growth had the highest average beta. All the growth stocks had the highest average beta of 1.98, and the high dividends had the lowest beta of 0.34. So there's not much difference between the beta of the CAN-SLIM strategy and the high dividend strategy, but there's a huge gap when you look at the growth strategy. So moving on to the average return, CAN-SLIM had the medium level of return, so I guess that's to be expected with the beta being in the middle. Is of 1.02% over the past 3 years. The growth has been 1.13%, and then the high dividend stocks have been just a little over 0.5%, 0.56%. And then when you look at their measure of risk, which I use standard deviation as a measure of risk, standard deviation of returns, the average standard deviation of the CAN-SLIM model was only 0.033. Growth was 0.14. And then the high dividend was 0.025. So once again, you can actually see that the growth, as you would expect, it does have the highest return, has a higher beta, but also has pretty high risk. The growth and CAN-SLIM and high dividend, they're pretty close in their average return. And then at the far end criteria is simply, did they beat the S&P? And all 3 strategies beat the S&P. And so just to kind of help better see it, I put it on the graph. Here's the average returns for the different strategies. Here's the average standard deviation. And I plotted them, so I marked it out. Here's the high dividend, CAN-SLIM, and growth. And what you can see is if you could draw a efficient frontier, all of them would fall onto that efficient frontier. But I really like the CAN-SLIM, and the reason being is for just a little bit more risk, you're getting a significant amount of return. And then if you move all the way to the growth, you're getting a little more return, but look at the amount of risk you're taking. So from high dividend to CAN-SLIM, little more risk, good bit more return. From CanSlim to growth, a lot more risk. I don't know if that return is really worth it. So in conclusion, CanSlim is a very competitive strategy with a high dividend and growth strategy. It came down to risk preferences, but looking at the three strategies, how much risk and how much return would you prefer? I personally like it the best out of the three. Like I said before, slightly more risk than the high dividend, but significantly more return, and has slightly less return than the growth, but significantly less risk. So it just kind of boiled down to your own preference. But I think CanSlim is a very solid investment strategy, and I personally think it outperformed these two. It fit my needs better than these two did. So that's my video, and thank you for watching.